ego microstops and whipsaw psychology on 1-minute scalps. The 1-minute chart doesn't wait for confidence. The cursor hovers over the entry, the level 2 ladder flickers, and your micro stop 5 ticks below the wick looks safe until it isn't. The candle snaps, your stop loss pings, and by the time your cortisol settles, price is back above your entry, as if mocking you. You click again to get it back, tighten the stop even more because you won't let it run you over twice, and then watch a 2-cent noise burst kick you out before the actual move launches. Green turns to red, your P&L boxes flash, the heartbeat in your ears syncs to the time and sales prints, and you swear the market is hunting your stops. It isn't. Your ego is. The tape is neutral. Your beliefs aren't. Most traders lose money. Past patterns don't guarantee the future. This is not financial advice. Risk management is survival. But right now, survival feels like making the next scalp work, because your identity is locked to the next candle's verdict instead of the next 100 trades. You're not getting whipsawed only by price. You're getting whipsawed by your brain's built-in settings around uncertainty, validation, and pain. Start with entry hesitation paralysis. On 1-minute scalps, the move often begins while your thumb is still negotiating with your amygdala. Every tick that prints without you triggers a small serotonin dip and a growing belief that you're late, pushing you toward a market order, right when liquidity thins classic FOMO timing. Then exit greed extension shows up. A green flash of dopamine on unrealized P&L biases you to expect just 5 more cents, even as order flow shifts and the volume profile tells you other timeframe participants aren't following through. Stop loss removal syndrome is next. Because getting stopped means, I was wrong. The ego quietly widens the stop to avoid that verdict, turning a controlled 1R scratch into a 3R spiral. When the inevitable red streak hits, revenge trading loops light up. Adrenaline from volatility, plus the narrative, they took my money, spawns impulsive re-entries that ignore your setup criteria. Overtrading compulsion follows. As Mark Douglas emphasized, beliefs about needing to win now hijack your probability mindset and pull you into noise you have no edge in. And when nothing clean is there, you'll see chart pattern hallucination. Your brain stitches flags into chop, wedges into random pivots, and confirmation bias makes each tiny wick look like destiny. The neuroscience underneath is brutally logical. Green candles and realized gains release dopamine, which rewards the behavior chain that preceded them, even if that chain was sloppy. Red P&L, especially after you tightened a stop, spikes cortisol. Now your attentional spotlight narrows to threat, not structure, so you miss the real signal and micromanage the microstop. Adrenaline surges scale your perception of opportunity. The ticking ladder feels like a once-in-a-lifetime moment, which it isn't. Accumulated losses deplete serotonin, correlating with pessimism after 2 or 3 scratches, so you bail early on the next winner to take something. Meanwhile, mirror neurons do their silent work. A chat room yelp of, I'm long, or a green blotter screenshot on Twitter makes your hands mimic their trade's social proof baked into motor readiness. None of that changes the tape, but it changes your readiness to trade your plan on a 60-second time frame, where a 5-second lapse equals an R. Then there's the trading paradox layer that 1-minute scalpers live inside. Perfect setups fail most often because perfection is crowded. When every eye sees the identical micro flag, liquidity layers just beyond your textbook stop create a vacuum for stop raids. Then the real move. The best trades feel uncomfortable. Entries against a micro swing after a liquidity sweep rarely feel good, because the P&L risk is front-loaded while the reward is delayed. More analysis on a 1-minute chart equals worse results. You don't have time for a 3-paragraph thesis between prints. Tighter stops, ironically, generate bigger losses. You get clipped repeatedly and respond by sizing up to make it back, converting many 0.3R scratches into a catastrophic day. And more screens add less clarity. A wall of indicators steals milliseconds of execution, focus you need for reading time and sales, and the inside market. The costly pattern shows up the same way across platforms. Trading view charts on one monitor, level 2, and order flow on another, Discord on the side. You define a setup, VBUAP reclaim with rising cumulative delta and a higher low, stop loss under the last micro swing. You take the first entry, but because the last 3 trades were scratches, you slide the stop closer to keep risk tight. The inside bid refreshes. A 2-lot spoof flutters on the offer. Your micro stop tags and price rips. Ego whispers, "They got you by a cent. You were right." That sentence detonates the next mistake. You re-enter without the same context, no higher low, no pace confirmation, pure narrative. Slippage eats a third of your planned R. The candle wicks again. You yank the stop to give it air, but now your R multiple is undefined. The move finally comes, and you're green. But you exit too early because the fear of giving back a win dwarfs the plan's target. End result, high effort, high stress, low expectancy. Anchoring to dollars lost, you widen risk on the next attempt to reclaim the felt identity of skilled scalper. That oversizing amplifies cortisol, you tighten stops again, whipsaw accelerates. By lunch, you've taken 15 trades to capture the move your original plan would have harvested in one. Meet Marcus, the scalp master. 50+ trades on volatile open days, thinks in ticks and spreads, and lives by each trade is one breath. 3 27-inch monitors, left for trading view with a 1-minute and 5-minute stacked via a clean layout. Center for DOM and level 2 with order flow footprint, right for a journal, pane and alerts. At 9:15, Marcus runs a micro pre-market routine, maps support Chinora resistance from the 5-minute, marks the overnight high-low, outlines his 3 ace setups and their invalidations, and sets alerts at key liquidity areas. He never moves a stop-loss once placed because he doesn't place it until the market proves the microstructure. Inspired by the way to trade, his rules are mechanical where they should be: risk per trade in R, maximum daily drawdown, a fixed number of attempts per level, and discretionary where context matters. Pace of tape, iceberg behavior, and how VBUAP responds to a liquidity sweep. Douglas's trading in the zone lives on his desk, reminding him that any single outcome is random, but the distribution of R multiples over 100 trades is not. He sizes positions by volatility, not emotion. If spread widens or pace increases, he reduces size automatically. When he's read wrong and takes 2 micro stops in a row, he doesn't interpret it as betrayal. He interprets it as regime info Steenbarger's trading psychology 2.0 process shifting from micro mean revert to momentum, or vice versa. So he changes tactics or steps aside. Marcus has blown up before the market wizard's lesson etched into his muscle memory. The worst drawdowns came after he got certain. His journal from those days reads like the disciplined trader's belief conflict chapter. Needing to be right led to changing stops, changing rules, and changing identity after each candle. Now he watches for the 6 biases as if they were signals. If he feels entry hesitation paralysis, he scratches size to half and requires a second cue, e.g. delta divergence in his footprint, before clicking. If exit greed extension shows up, he executes a partial at 1R and parks a bracket for 2R. If the bracket isn't hit, he doesn't touch it. If stop-loss removal syndrome even whispers, he hits flat manually and calls a 1-minute breathing protocol. For revenge trading, he runs a walk-away timer, 2 minutes off the screen after any 1.5R sequence. Overtrading compulsion gets measured. He caps attempts per level at 2. Chart pattern hallucination is defanged by an objective checklist. No delta confirmation, no higher-low structure, no trade. His mantra from trading in the zone, the market owes him nothing. His job is to execute positive expectancy. How did he rewire? With a scalper's version of deliberate practice. First, pre-market. He scripts 3 what-if scenarios for each A setup, Steenbarger's mental rehearsal, and imagines the physiology of each adrenaline hit on a sudden wick, cortisol spike on a premature stop, dopamine buzz on quick green, then rehearses the behavior. Breathe, recenter eyes on the inside market, say his micro rule aloud, stop his information, don't edit information. Second, position sizing. He sets a fixed R per trade and a fixed risk ladder. Start at 0.5R on the first attempt at a level, 0.5R on the second, and only scale to 1R after the market confirms with a higher low and trapped shorts or reverse for shorts. He never escalates size because he's down. He escalates only because structure improved. Third, stop placement. No micro stops tucked under the nearest wick. He places stops at structure that invalidates the idea. Low of the micro swing plus spread and a noise buffer calculated from last 3 pullbacks median. If he cannot afford the stop, he cannot afford the trade. the way to trade's mechanical boundary. Fourth, alerts over attention. He uses TradingView alerts at liquidity zones so he doesn't stare at noise. Fifth, the two-gate rule. Gate 1 is context, VWAP relationship, volume profile, liquidity sweep. Gate 2 is execution, pace of tape, delta turn, bid-ask absorption. If both gates aren't open, no click. Sixth, cooling off periods. After any 2 are cumulative in 15 minutes, the walkaway timer and a protein bar, neurochemistry, needs a reset. Seventh, a mechanical daily circuit breaker. At 4R realized on the day, platform disables the buy-sell hotkeys via a macro risk management is survival. He built a micro review ritual, borrowed from Trading Psychology 2.0, 10 screenshots per session, all trades overlaid with pre-trade context notes, order flow snapshots at entry, daxine, exit, and a single line answer to which belief spoke. He tags each trade with one of the 6 biases. He also tags paradox triggers. Did a perfect flag fail because it was too obvious? Did an uncomfortable entry like buying the reclaim after a stop run deliver the best R? Over time, patterns emerge. He discovered his worst results came from shrinking stops to feel safe. He learned his best winners began with a breath of discomfort and a stop at true invalidation. He shifted from money goals to process goals. The disciplined trader's focus and measured days by, did I trade the plan? Not, how much did I make? He kept the statistics honest. Most traders lose money, sits in his workspace not as a threat but as a standard. His edge must live in our multiple math, not opinion. Marcus also integrated Market Wizard's humility. Whenever he has 3 strong days, he cuts size by 25% on day 4. The goal is to undercut the ego's certainty. He keeps a small practice account, where he tests new micro edges at 1/10 size, so the dopamine of novelty doesn't contaminate his production account. His stop policy is non-negotiable. Stops are placed at order entry, bracketed, and never widened. When he feels the urge to give it air, he reads his one-line prompt. Air is what burns accounts. If the structure dictates more room, he reduces size. If he can't reduce size due to minimum lot constraints, he passes. He rotates between 2 scalper archetypes within himself. The system trader in the morning, mechanical triggers, no discretion. The algo hybrid in the late morning lets human reads of tape nuance entries but keeps risk mechanical. By lunch he stops. Afternoons are for review unless a fresh catalyst shows. The transformation you're aiming for isn't a superhuman calm. It's a system that makes your human chemistry affordable. Picture your next open. You map levels, you set alerts, and you choose one A setup to specialize in for the day, say, the VBU app reclaim after a liquidity sweep with delta confirmation. You accept in advance that the first 2 attempts might be scratches, because the distribution of outcomes is random across individual trades. Your stop sits where your idea is wrong, not where your fear is slightly quiet. The tape fakes you once. You breathe, you don't re-enter until gate 1 and gate 2 are both open. The second entry are triggers, and you don't babysit the bracket. At 1R, you partial. At 2R, you let the last runner either tag or trail using a session swing. The win feels underwhelming. Good. That means dopamine didn't steal the steering wheel. If it's a loss, it's 1R, logged fast, ritual complete. You finish green or red for the day, but consistent in execution. Your identity is no longer measured by the last minute's candle, but by the last 100 trades' expectancy. You exit the platform on your circuit breaker, journal 10 screenshots, tag the bias that tried to speak, and plan the next session with fresh eyes. The 1-minute chart didn't slow down. You did by design. Most traders lose money. Not because they can't read a chart, but because they can't read themselves while reading a chart. Past patterns don't guarantee the future. But your process can guarantee that when the future prints, your stop is an information point, not a negotiation. Risk management is survival. On a 1-minute scalp, that means surrendering the ego's need to be right and letting rules hum quietly while price does what it always does, move in ways that feel unfair in the short run, and statistically fair over a long series. Each trade is one breath. Breathe, place the stop where the idea dies, and let the distribution live.